Hi, you're alive, and unless you plan to live in a cave eating moss, you need money. Not just to have it, but to understand it, manage it, and stop it from vanishing mysteriously every month. That's called financial literacy. It's the difference between retiring on a beach and retiring in your daughter's basement. Let's fix that. Personal Finance 101. The basics no one taught you. First rule, track your money. Sounds boring? Too bad. You can't manage what you don't measure. Money comes in, that's income. Money goes out, that's expenses. The gap between them, that's everything. If income exceeds expenses, congratulations, you're winning. If expenses exceed income, you're slowly drowning in a pool of DoorDash receipts and subscription services you forgot existed. So make a budget. It's just a plan for your money. List what comes in, list what goes out. The 50-30-20 rule is popular. 50% for needs, rent, food, not dying. 30% for wants, Netflix, concerts, oat milk lattes. 20% for savings and debt. Adjust as needed. If your rent is 60% of your income, you don't live in an apartment, you live in a financial hostage situation. But budgets fail if you can't stick to them. That's where cash flow matters. It's the timing of money moving. You can be rich on paper and still bounce a rent check if all your money arrives Thursday, but rent's due Tuesday. Pay attention to when money moves, not just how much. The emergency fund, your financial airbag. Life will punch you in the face. Your car will die. Your laptop will drown in coffee. Your teeth will riot. That's why you need an emergency fund. It's money you don't touch unless something breaks, burns, or requires an ER visit. How much? Start with $1,000, then build to 3 to 6 months of expenses. Keep it in a savings account, not investments. Why? Because when your transmission explodes, you can't wait for the stock market to recover. Liquidity beats returns here. This fund prevents you from going into debt every time chaos shows up, and chaos always shows up. Debt, the financial quicksand. Debt is borrowing future money to spend today. Sometimes smart, often dumb, always expensive. There's good debt and bad debt. Good debt theoretically makes you money later, like student loans for a valuable degree or a mortgage on an appreciating house. Bad debt funds consumption. Credit cards for shoes, payday loans for groceries, car loans for a truck you can't afford to impress people you don't like. The killer is interest. It's the cost of renting someone else's money. Credit cards charge 18 to 25% annually. That's obscene. If you owe $5,000 and pay only minimums, you'll spend years and thousands in interest. It's like paying $50 for a $30 pizza every month forever.
Credit scores, your financial report card. Your credit score is a number between 300 and 850 that tells lenders if you're trustworthy. Higher score, lower interest rates. Lower score, you'll pay extra for everything or get rejected entirely. It's based on 5 things: payment history, 35%, amounts owed, 30%, length of credit history, 15%, new credit, 10%, and credit mix, 10%. How to build good credit? Pay bills on time, every time. Keep credit card balances low, under 30% of your limit. Don't close old accounts. Don't apply for 12 credit cards in 1 month. Basically, be boring and reliable. Lenders love boring. Check your credit report annually for free at annualcreditreport.com. Errors happen. Dispute them. And no, checking your own score doesn't hurt it. That's a myth, like financial wellness webinars being useful. Saving versus investing. Know the difference. Saving is putting money aside safely, like a savings account. It earns maybe 0.5% to 5% interest depending on the bank and current rates. Safe, boring, and your money's there when you need it. Investing is putting money into assets hoping they grow. Stocks, bonds, real estate, index funds, Bitcoin if you hate sleep. Potential returns? Much higher. Risk? Also much higher. You could double your money or lose half. That's volatility. Here's the rule. Emergency fund and short-term goals, savings. Long-term goals like retirement and 30 years, investing. You need both. Saving alone loses to inflation. If prices rise 3% per year and your savings earn 1%, you're getting poorer in real terms. Investing fights that, but requires time and stomach for the rod. Retirement. Future you will thank you. You will get old. Shopping, I know. And when you do, you probably won't want to work. That's retirement. But retirement costs money. Lots of it. Social Security might give you some, but not enough to live well. You'll need your own savings. Enter retirement accounts. In the US, that's 401ks and IRAs. If 401k is through your employer, you contribute pre-tax money, it grows tax-free, and you pay taxes when you withdraw in retirement. Many employers match contributions. If yours does, contribute at least enough to get the full match. That's free money. Refusing it is like declining a raise. An IRA is individual retirement account. You open it yourself. Two types: traditional IRA, tax deduction now, pay taxes later, and Roth IRA, pay taxes now, tax-free withdrawals later. Roth is great if you're young and expect higher income later. How much to save? Aim for 15% of your income. Can't do that? Start with 5%, then increase 1% per year. Thanks to compound interest, even small amounts grow huge over time. $200 monthly at 8% annual return for 30 years, about $300,000. That's the magic of time and compounding. Start early, even if it's tiny. Investing basics? Don't be stupid. Most people shouldn't pick individual stocks. You're not smarter than the market. You will lose. Instead, buy index funds. They track the whole market, like the S&P 500. Low fees, broad diversification, historically solid returns. Set it, forget it, get rich slowly. Diversification means don't put all your money in one thing. Spread it across stocks, bonds, maybe real estate. If one crashes, the others cushion the blow. It's the investing equivalent of not keeping all your eggs in a basket held by a drunk toddler. Understand risk tolerance. Can you watch your portfolio drop 30% and not panic sell? Then you can handle stocks. Does a 5% dip make you nauseous? Stick to bonds and safer assets. Investing is long-term. Don't check it daily. Don't sell in a panic. Time in the market beats timing the market. Always. And avoid financial advisors who take 1 to 2% annually. Fees compound negatively. Over 30 years, they'll eat a third of your returns. Use low-cost robo-advisors or target date funds instead. If you need advice, pay hourly, not a percentage. Insurance, betting against yourself. Insurance is paying someone to cover you if something bad happens. You're literally betting you'll get unlucky, and the insurance company is betting you won't. Statistically, they win, but you still need it because one big disaster can ruin you. Health insurance is non-negotiable. Medical bills are the leading cause of bankruptcy in the US. Get covered. Life insurance if people depend on your income. Term life is cheap and sufficient. Skip whole life. It's overpriced garbage sold by people in seats. Car insurance, legally required most places and smartly required everywhere. Renters or homeowners insurance protects your stuff. Disability insurance replaces income if you can't work. Underrated. Super important. What you don't need: insurance on your phone, your appliances, or extended warranties on anything. Those are profit centers, not protection. Taxes? Unavoidable, but manageable. You will pay taxes. Accept it. Income tax, property tax, sales tax, death tax, taxes on your taxes. But you can reduce them legally. That's tax planning. Contribute to retirement accounts. That's a deduction. Deduct mortgage interest if you own a home. Claim education credits. Keep receipts for business expenses if you freelance. Use tax advantage accounts like HSAs for healthcare or 529s for education savings. File your taxes correctly and on time. Use software like TurboTax or Free Tax USA for simple returns. Hire a CPA if your situation's complex. Don't evade taxes. The IRS is slow, but inevitable. They will find you, and they don't forgive. Financial goals. The why behind the work. Money isn't the goal, it's the tool. What do you actually want? A house? Travel? Freedom to quit your job? Write down your goals. Make them specific. Save more is vague. Save $20,000 for a down payment in 3 years. That's a plan. Break big goals into small steps. $20,000 sounds impossible. $555 per month? Doable. Automate it. Set up automatic transfers to savings the day you get paid. You can't spend what you don't see. Prioritize. You can't do everything at once. Emergency fund first, then debt, then retirement, then other goals. Sequence matters. The behavior part: why we suck at this. We know what to do. We just don't do it. Why? Because humans are wired wrong for modern finance. We want instant gratification. We're terrible at delaying rewards. We compare ourselves to others and overspend to keep up. We fall for lifestyle inflation. Every raise means a bigger apartment and fancier dinners, so we never actually get ahead. The fix: automate good behavior. Autosave, auto-invest, auto-pay bills. Remove temptation. Delete shopping apps. Unsubscribe from marketing emails. Find free fun. And remember, wealth isn't about how much you make, it's how much you keep. The bottom line: financial literacy isn't complicated, it's just unsexy. Budget, save, avoid bad debt, invest for the long term, insure against disasters, plan for retirement. Don't be stupid with money. Do this, and you'll be fine. Not rich necessarily, but stable, secure, and not panicking at 3 a.m. about overdraft fees. And that, honestly, is the dream.